Let me introduce Sandrine, and Sandrine has been in contact with our center, GCF, for a long time. So as our friends and support, and she has been supporting our center activities, and this is one of the evidence. So Sandrine is now a professor at the University of East Paris, Créteil, too. It's a little town's name. And I would say Sandra has been doing a lot of research in the similar field as I am doing. So in the financial economics, corporate finance, firm behavior, and also I think a lot of papers on emerging market, on African. And we had a lot of talk, in terms of research on Africa, and also Sandra has worked with different organizations like ESSEC, and I can see the name is a very big business school, and on some other projects, and Sandra has obtained her PhD in economics and Masters of Science in International Economics, modeling of international economic problems. But Sandra, you did not see, where did you get your degree? Can you tell us?
I got it in the University of East Paris, Créteil.
Oh, the same university.
In the University of Nanterre.
I see. Okay, Nanterre. Great. So, and I did not see the journals in which Sandra has published, but I just got some information on the most recent publication, and that is in the Journal of Comparative Economics on the topic of firms' access to finance and resource curse problem. So again, it is about the firms from emerging and developing countries. And similarly today, we see a topic here, which is again on developing and emerging countries' economies, and it is about digital wage payments and financial inclusion. So recently, such a topic is actually very popular in the area in research regarding to emerging and developing economies, because it's about financial inclusion. So I'm very curious to know from Sandra about the details, and including econometrics, as we always pay attention to. So Sandra, if you are ready, I give the floor to you, please.
Okay. Thank you, Hong, for introducing me, and thank you for inviting me to this CGF seminar. I'm very happy to be here. It's always a pleasure for me to be in CGF seminars for presentation or to present papers at a conference organized by the Center of Global Finance. So today I'm going to tell you about the link, the possible link that exists between digital wage payment and financial inclusion in developing and emerging economies. Indeed, why we are interested in these relationship, and we think that there is an influence, a positive impact of digital wage payment on financial inclusion. It's because this last year there has been a kind of, a dramatical evolution of fintech, which has strongly influenced and positively impacted financial inclusion. And we think that this issue could be very interesting to analyze, as digital wage payment is part of fintech. So this paper has been written by me and two colleagues of the University of Orleans, Their name is Ismail Bello and Sebastian Garanti. So now what I'm going to do is to introduce the paper. And first, I would like to tell you about, to define financial inclusion. So generally in the literature, we will present financial inclusion as both access to and use of appropriate, affordable, and accessible financial services. So as defined, many economists will use account ownerships to grasp financial inclusion, and they will present account of ownership as the first step of financial inclusion. Why? Because account ownership allows accounts allow its owner to safely and affordably store, send, and receive money for everyday needs and plan for emergencies. And these are things that are very important for policy intended to improve financial inclusion, because policymakers will be interested in the fact that people who are excluded from the financial system, and also people who are not really, how can I say it? Not really included, not using the traditional financial services. I mean, there are people who have not, don't have a bank account. I mean, those authorities will pay attention to the fact that those people will be able to keep money, save money, make plans for emergency, pay for emergencies, and so on. Now, when we look at statistics related to account ownership, we can see that there is a gap between developed countries and developing countries. So, for example, the Global Findex gives some statistics for developed countries and for developing countries. When you look at the rate of account ownership in France, Germany, United Kingdom, Australia, you will see that they are around 100%, while for a country like Nigeria, Indonesia, Ghana, and Kenya, they are respectively 45%, 52%, 68%, and 78%. So when we look all this, we can ask ourselves, why this gap? In fact, in the past, in developed countries, there were some legislation that were set in order to improve the bancarization of the population, and several rounds of those legislation were set and lead to the improvement of account ownership and deeper financial inclusion. Now, concerning developing countries, in recent years, there have been several articles that have pinpointed the importance of fintech through mobile money for financial inclusion. So all those papers have shown how fintech has transformed the financial system, and extensively how mobile money has also improved financial inclusion in developing countries. Besides, there were also several articles that have analyzed the issue of wage payments. However, those articles were limited in scope, subject, or type of payments. So all these lead us to raise the following research question. So the research question is the following: how do wage payment, and especially digital wage, play a role in increasing or improving financial inclusion? So to answer this question, we will construct a financial inclusion index, and we will then relate this index to digital wage payment to assess its impact on financial inclusion. So before going to the methodology we use in this paper, we look at the literature review. So I will come back again on the idea of financial inclusion, and I will pinpoint the fact that financial inclusion refers to the fact that all individuals in a society should benefit the advantages provided by financial services. So with this definition, with this idea of financial inclusion, we can see that there is the idea of access. Access to financial services and financial products for the most vulnerable and excluded people of the society. So this is something that policymakers will aim when they will set policies for improving financial inclusion. And we will also see that generally, when we look at studies in financial inclusion,
Sandrine,
yes,
please, people, can you mute your mic, please? Yeah, Sandrine.
Yes. Okay.
Yeah. Sorry.
Thank you.
You can now continue, please. Yeah.
Okay. So when you have when we look, you look at studies on financial inclusion, you will notice that they focus on two additional aspects apart from access. So they will pinpoint penetration and usage. So now what I would like to do is to define those three aspects of financial inclusion. So access, as I previously told you about, reflects the depth of outreach of financial services. It also represents the possibility for individuals to use financial services through financial infrastructures. So with access, you have this notion of financial infrastructures, which means that there is a necessity for financial infrastructure so that people can use financial services and financial products. Besides access, you have penetration. Penetration defines how many registered users of bank account or mobile money we have in the context of financial inclusion. That means that with penetration, we will stress the number of registered users, which will lead us to the concept of usage, because with penetration, we grasp the number of registered users, but we don't know how regularly those registered users use financial products. So this is what usage will lead us to grasp. So usage measure how clients use financial services, such as the regularity and duration of the financial product service over time. So because of this composite definition of financial inclusion, several articles, when trying to measure the evolution of financial inclusion, they try to build a composite index of financial inclusion. However, those recent years, as I have explained, there have been an important evolution of fintech, which has positively impact financial inclusion. So now when we are talking about financial inclusion, we have to consider the two aspects of financial inclusion: traditional financial inclusion and digital financial inclusion. Again, when we look at the literature, we can see that there is a strand of literature that focused on digital wages and inclusion or account ownership. However, all those studies are limited. They are limited in scope because they would be interested on a single country. They would be interested only on a type of person. For example, they will treat digital payment or digital wage with payment with entrepreneurs. Or also they will treat a certain type of payments like government to person or business to person. So this means that in the literature, to the best of our knowledge, there is no particular attention that is paid to the effects of digital wage payments on financial inclusion, particularly digital and traditional inclusion. So to answer this flow of the literature, we construct in our paper a new index comprises of 2 indices, one index on traditional banking financial inclusion, and the second one on digital financial inclusion. We decompose the indices into access, penetration, and usage. Then we assess the impact of digital wage payments that are wages received in account because they are made through electronic means, phone, wages received through mobile phone and through card. So we assess the impact of those digital wage payments on traditional financial inclusion and digital financial inclusion. Now, what I would like to do before going to the methodology used for the computation of our index, I would like to show you some stylized facts. So here, what I'm going to do is to present some indicators that allow us to grasp the different aspects of financial inclusion. So the first aspect of financial inclusion, as I said, is access. We choose 2 indicators, namely commercial bank branches per 100,000 adults and ATMs per 100,000 adults. So what we can see here roughly is there is a dominant region, which is Europe and Central Asia. And the indicator is evolving slightly. Again, one feature that is important to mention is the important increase of ATMs in sub-Saharan Africa, especially in 2021, which shows policies set by authorities, I mean measures taken by financial authorities to vulgarize ATMs in those countries. As for penetration, we chose two indicators, financial institution account and mobile money accounts. So there is an evolution, as you can see. The dominant region, I mean the region with the highest level for those 2 indicators, are East Asia and Pacific, Europe and Central Asia, and Latin America and Caribbean. And again, a striking feature is the increase of mobile money account in sub-Saharan Africa, which is very high as compared to other regions. Now, to end, we chose 4 indicators for usage. So, first indicator, saved at the financial institutions. And the second is borrowed from the formal financial institutions. Again, there is a slight evolution. The dominant regions are the same, the 3 that we have already mentioned. And finally, for made a deposit, made a withdrawal, for those 2 last indicators, they are quite similar in the different regions, and the evolution is quite steady. Which question us as for the evolution and level of the three aspects of financial inclusion on traditional financial inclusion. Indeed, there is a gap between access, penetration, and usage ratios, which implies some limits as for this traditional financial inclusion. So when we look at the literature, comments made on the literature, they explain these gaps by the lack of adequate financial infrastructures, such as ATMs, commercial bank branches, internet, but also the literacy rate between rural and urban areas. There is a limitation in access, which therefore limits penetration and usage of financial services. And finally, among the most commonly reported barriers to account use, the literature mentioned cost, physical distance, and lack of proper documentation. So finally, what we are going to mention here for the stylized facts is two features. So the first one related to account ownerships. So for account ownership, we can see that Asia and Pacific display the highest percentage at 80% among developing regions, as compared to 39.70% in 2021 for Sub-Saharan Africa. However, for mobile account ownership, Sub-Saharan Africa is leading up with 33.2%, while other developing regions display rates inferior to 17%. So this shows that at the end of the day, there is a kind of different picture showed by Sub-Saharan Africa as for digital finance and especially mobile finance. Now that we have presented the stylized facts, we can turn to our methodology and explain how we proceed to compute our index, our composite index of financial inclusion. And then after, in the second step, how we show the relationship between digital wage payments and financial inclusion. So as I was saying, as we were discussing previously with Hong, the data used are of two sources. First source is the Global Findex database, and second source is the Financial Access Survey, GSMA mobile money data sets. So the first one is collected by the World Bank, and second by the IMF. So our time span is 2014 to 2021. So we have 3 years. It's not really a panel, but we make the computation of the index with these 3 years, and we make also the fractional regression using these 3 years.
And then Sandrine,
yes,
is that 3 years? Is it from 2014 to 2021?
So the observations are made in 3 points of time: 2014, 2017, and 2021.
Oh.
Because for all those data related to financial inclusion, they are collected through survey, and the survey is not implemented every year.
Yeah, okay.
They are made in certain point of time. So the available data were for those 3 years, 2014, 2017, and 2021.
Okay, clear. Thank you.
So we have, again, we have some limitation as for the number of available countries that are observed. We have 45 emerging and developing economies. So in those two databases, we had some developed countries, but we prefer to focus on developing and emerging countries, as nowadays, when we are talking about financial inclusion, I mean, the literature is more interested in dealing with financial inclusion in emerging and developing countries. I think it's something more relevant because those countries display lower level of financial inclusion. So within our sample, we have 6 developing and emerging regions. Sub-Saharan Africa, we have 21 countries of Sub-Saharan Africa, 8 countries for East Asia and Pacific, 3 for Europe and Central Asia, 4 for Latin America and Caribbean. South Asia, we have 6. Middle East and Northern Africa, we have 3 countries. Okay, so the data that we have were not readily usable. What do I mean? They need to be treated because they presented some limits. So the first treatment that we made is the following. Most variables, as you've seen with the indicators related to access, penetration, and usage, most variables are expressed in percents, and some are not expressed in percents. So to have to harmonize those variables, we use the population. We divided those variables for the population so that we were able to have a percentage, which is more comparable to other variable presented as percentage. For missing data, we make some interpolation with a proxy variable as advised by Kera and Al. For instance, we interpolate mobile money agent with mobile money account and mobile money transaction with the percent of adults who made or received digital payments. And finally, we made some normalization because variables are in different scale and highly skewed. So the literature advised to use the min-max methods in order to have them in the same scale. So this is what we did. Now, with the treated variable, we proceed to the computation of our financial inclusion index. So the financial inclusion, as I said, is a multi-dimensional concept. You have the access, you have the three aspects, as I said, in financial inclusion. You have access, you have penetration, and you also have usage. So it means that if we want to grasp financial inclusion, we want to measure it, it is more interesting to use a composite index to calculate it, to grasp it using a composite index, because a single indicator cannot grasp the whole, all the dimensions of financial inclusion. So in the literature, we have two methodologies to measure such a composite index. You have non-parametric methods. In non-parametric methods, weights are endogenously determined based on the information structure of sample indicators. And you also have the parametric methods. In those methods, weights are exogenously determined based on researchers' intuition, which may result to biased estimation. And because of this bias, we will choose the first method, and among those non-parametric methods, we will use the principal component analysis. So what's the principal analysis? What's the principal component analysis? Roughly, it is a method that will capture in each indicators the weight of this indicator, and will capture them. We capture them by encompassing in the measure the indicators which contribute the most to financial inclusion, for example. So this method is also interesting because it deals with it helps dealing with possible correlation between the variables. So as for our study, we implement these component, principal component analysis in two stages. Why? Because it allows avoiding weight bias towards indicators that exhibit the highest correlation, as I explained, because if we mix all the indicators, because of the multiple correlation, this will give us a biased result. So because of this reason, Camara and Tuesta will suggest to proceed in different steps. And here, we will do it in 3 steps. So roughly what we do is to construct a composite financial inclusion index encompassing both traditional and digital financial inclusion. And among those sub-indices of digital and financial inclusion, we consider the 3 aspects of financial inclusion that are access, penetration, and usage. So to calculate the indice, we use the following indicators. So for example, for the traditional financial inclusion index, we consider the sub-indices access. So for access, we have two indicators: number of commercial bank branches per 100,000 adults, number of ATMs per 100,000 adults. For the sub-index penetration, we have three indicators: financial institution account, deposit account with a financial institution account, and owns a debit or credit card. And finally, for the sub-index usage, we have several indicators, 5, among which we have borrowed from a formal financial institution and use a debit or credit card. So we do the same for the Digital Financial Inclusion Index. For the sub-index access, we have 4 indicators, among which the number of registered mobile money agent outlets and individuals who have access to internet. For the sub-index penetration, we have number of registered mobile money accounts, number of active mobile money accounts. And finally, for the sub-index usage, we have 4 indicators, among which we have the value of mobile money transaction and the use a mobile phone or the internet to pay bills. So again, let me present you in detail the 3 steps. So roughly the model is the following. We compute the financial inclusion index using the sub-index related to access, penetration, and usage. So those index have been calculated. I've been calculating the following way. We have in the first stage of PCA, we calculate the traditional financial inclusion. So this traditional financial inclusion has 3 components. This traditional financial inclusion index has 3 components. So the traditional financial inclusion component related to access, which is calculated using the 2 indicators that we have previously mentioned. So if I come back, it's those 2 indicators. And again, for the traditional financial index related to penetration, we use the 3 indicator that we have mentioned here, and so forth. And we do the same for digital financial inclusion using the indicator I have previously presented to grasp the sub-index related to access. So digital financial inclusion for access, digital financial inclusion for penetration, digital financial inclusion for usage. And then for the second stage of PCA, we how can I say, we calculate the traditional financial inclusion index, taking into account the different aspects of financial inclusion related to traditional financial inclusion. I guess it's okay, but we compute in the second stage the traditional financial inclusion using the sub-indices we obtain during the first stage, and those sub-indices are related to access, penetration, and usage. And the same for digital financial inclusion. And finally, for the first stage, we calculate the composite index, which is comprehensive financial inclusion index, in which you will have the traditional financial index and the digital financial index. So before presenting you the financial inclusion indices, let me check, let me present you the check for the robustness and consistency of our financial inclusion indices. We use the approach of Tram and Al. They're advised to use the correlation between one indicator, which is closely related, which allow to grasp financial inclusion. So this indicator is account ownership, because this is the one presented in the introduction, and the one that is used by many economists in the literature. So we try to see the correlation between account ownership and our index of financial inclusion. And as you can see, the correlation coefficient are important, especially for the comprehensive financial inclusion index and the traditional financial inclusion index. For digital financial inclusion index, the coefficient correlation is lower, but still our results are quite consistent and robust. Now, for the comments, for the presentation of the results related to financial inclusion, I will present them in a synthesized form. I will summarize, the presentation using histogram and graphs. So here we have the first stage results for the computation of financial inclusion indices. So you have the different aspects of financial inclusion, of the traditional financial inclusion: access, penetration, and usage. So access appear here in green, penetration in red, and access in blue. So again, with no surprise, what we can see is the fact that there is a dominance of the three regions, which are East Asia and Pacific, Europe and Central Asia, Latin America and Caribbean. We can see that for Sub-Saharan Africa, there is a high level of penetration and usage, but for access, which is more related to infrastructure, it's very low. Now, when we turn to digital financial inclusion, we can see that always we have for access aspect of financial or digital financial access, the dominant regions are East Asian Pacific, Europe and Central Asia, Latin American, Caribbean. But when we look at the other aspect of digital financial inclusion, we can see that Sub-Saharan Africa is leading up, especially with usage and penetration. So this is a striking feature for digital financial inclusion, and we can see that especially for penetration and usage, there is a high level for the sub-indices when the sub-indices of Sub-Saharan Africa. Sorry. Now, as for the evolution of the composite index of digital financial inclusion and traditional financial inclusion, it's always the same picture. You can see that for the different region, you have a clear evolution. You have a dominance, if I may say, for the free region, East Asia and Pacific, Europe and Central Asia, Latin America and Caribbean. But still, if you look at Sub-Saharan Africa, you can see that digital financial inclusion is more important than traditional financial inclusion. So again, these striking features appear for Africa, and especially for year 2021. For this graph, we made a scatter plot of traditional versus digital financial inclusion. And what we can see is an evolution of, positive evolution of traditional versus digital financial inclusion. And if we compare it with the 45-degree line, we can see that it's below, which means that digital financial inclusion is kind of evolving quicker than traditional financial inclusion. So, which is also a striking picture of digital financial inclusion as compared to traditional financial inclusion. Now we finish the comments of the result related to the computation of financial inclusion indices by showing the comprehensive financial inclusion index, which encompasses the three aspects of financial inclusion as well as the two dimensions of financial inclusion, namely traditional financial inclusion and digital financial inclusion. What is interesting here is, of course, you have a kind of dominance. I mean, the indices related, sub-indices related to traditional financial inclusion are higher than sub-indices related to digital financial inclusion. But what is interesting is the importance of usage, the usage aspect, which shows that with digital financial inclusion, even if there is some limitations in terms of access or penetration, the usage is far more important. So this is also very important for policymakers. And finally, the last histogram shows that, of course, traditional financial inclusion is far more important than digital financial inclusion. Now, we go to the second part of our paper, which is devoted to analyze and to assess the impact of digital wage on financial inclusion. So this is the reason why we calculated our composite financial inclusion index. But we are confronted to one issue. The financial inclusion indices that we have, whether they are traditional, digital, or comprehensive, they are bounded between 0 and 1. So traditional least square regression is not appropriate and gives biased results. So the literature suggests the use of double truncated Tobit model. However,
Sandrine, please. Louis, can you mute your mic? We can hear you. We can hear you. Louis, please. Yeah, thank you.
Okay.
Yeah, thank you. And Sandrine, sorry. Sorry, please come back.
No problem. So the literature suggests the use of double truncated Tobit model. However, there is one criticism with this model. Indeed, we lose some information since the explanatory variables are coded to be 0 or 1. Therefore, the literature will suggest the fractional logit regression model, which was introduced by Park and Woolrich. So we employed this fractional regression model. This fractional regression model requires the assumption of a functional form that constrains the conditional means of the dependent variable as follows. So here, Y represents the financial inclusion index, while X represents the digital wage payments, digital wage means of payments. So this means that at the end of the day, we estimate 3 logit models for the comprehensive traditional index, the comprehensive financial inclusion index, the traditional financial inclusion index, and the digital financial inclusion index. So from each equation, we will have digital wage payments that are wage received into accounts because they are made for electronic means. wage received through mobile phone, and wage received through card. And we also test wage received in cash. So they are all regress on indices or of financial regression with this logistic function. So here are the results. So the first results are for the traditional financial inclusion. So we did it for every index, every financial inclusion index. So the first one is a traditional financial index. So as you can see, you have a positive impact of wage received into an account on traditional financial inclusion, as well as wage received by phone and wage received through card. But you have a negative impact of wage received in cash. And you have qualitatively the same results for the digital financial inclusion. So positive for wage received into an account, wage received through mobile phone. For wage received through card, it's negative but non-significant, and a negative impact of wage received in cash. And finally, for the comprehensive financial inclusion index, we have a positive impact for the first type of wage payments. Positive one for wage received through phone, positive and non-significant when we add control variable for wage received through card, and negative for wage received through wage received in cash. And yes, I forgot to say that we add some control variable which are common in the literature and which seems to us to be the most relevant. So they are the GDP per capita, the FDI, foreign direct investment, inflation, population density, and the literacy rate. So as we had a logistic function, it is important to calculate the average marginal effects. So as you can see, they are significant consistently with our previous results, and they are also important even for traditional financial inclusion index. So this is important for policymaker because this means that digital wage payment have a significant impact on digital financial inclusion, but also on traditional financial inclusion, which means that there is something for policymakers to keep in mind in order to improve financial inclusion. And at the end of the day, we can see that for the comprehensive financial inclusion index, the marginal effect is also important. So to how can I say, to show that our results are solid, we made some robustness checks. So the first robustness check is to calculate an alternative index, yes, using an alternative method. So we use the linear mathematical model of the integrated indicator by Dlugopolski. And we also made as a second robustness check, we also introduce additional variable in our fractional logit regression. We introduced some institutional variables like corruption, political stability, and absence of terrorism. We also use a fractional probit regression model as an alternative technique. We question endogeneity, and to this purpose, we use the IV fractional probit regression. For the instrumental variable, we use total labor force, lag of digital wages, and also the lag of control yes, the former control variable that we have used, inflation, GDP, population density, as advised by Kouladum et al. So for the two first robustness checks, I won't show you the result, but they were consistent with our previous results. But what I'm going to do is to show you the results related to the fractional probability regression and the result related to IV fractional probability, which question under G90. So as you can see, each time we have the fractional probability regression model and the IV fractional probability, and you can see that the results are consistent with the previous result. We have qualitatively the same results. So for each indicator, for each financial inclusion index. So the first one is for traditional financial inclusion. The second one is for digital financial inclusion. And the third one is for the comprehensive financial inclusion, which encompasses traditional and digital financial inclusion. So roughly, our results are qualitatively the same, so which shows that our results are robust. And this leads me to conclude by saying that our first idea was to measure the influence of digital wage payment on financial inclusion, because we had in mind that in the past for developed countries, when the legislator implement the law according to which wage should be paid in an account, this lead to a high bancarization of the population, a deeper financial inclusion. We think that there could be a kind of parallelism with developing countries, but this time with digital finance and especially digital wage payments. And of course, digital wage payments has increased both last year in developing countries. And with this increase of digital wage payment, which is part of digital financial inclusion, we think that there is an improvement of digital financial inclusion, but also financial inclusion. So we think that there should be a regulation that should be set in developing countries to foster the payment of wage through digital financial means, especially for countries like Africa, because when we look at data related to Africa, we can see that with digital finance, with every statistic related to digital finance, Africa is leading up. Digital services and digital financial service and digital financial products are well accepted by the African population. So it could be a way to increase financial inclusion in developing countries for which it's very difficult to improve very quickly financial inclusion. So it could be a solution. But besides, we advise that financial authorities set a strong regulation to accompany digital wage payments, because in so doing, they will reassure the population in this regard. So thank you for your attention. Your comments and questions are welcome, because I think that there is always things to improve, and I hope that the discussion will be fruitful. Thank you.
Yeah, thank you, Sandrine. And that was a very careful presentation and with a lot of details. And you, as far as I can see, I think the topic, no doubt, is very, very important for emerging market and for less developed countries. And you put a lot of efforts on the first part of the paper or empirical analysis, and that is the construction of your financial inclusion indicators. So, and you use the proper econometric method to do so. And then in the second stage, you regress the digital wage payment, and you check the impact of digital wage payment on those financial inclusion indicators separately. And so you got some result. I think they do have some policy implications, but my question starts the other way around. Let's start from the policy implications. So when you introduced the topic, you showed us a lot of background statistics regarding let's say, access, the usage, and also penetration indicators, etc. So we see a lot of differences between regions. So for example, you emphasized that Africa is actually standing out in terms of their digital financial inclusion. So I say financial inclusion in terms of the digital thing is more important than the traditional. Probably I can understand that. So that is in contrast to the situation in Southeast Asia. I can imagine that. So my first question will be your policy implications. So you did not really check the differences in your result across the different regions. So I was thinking, Middle East countries, they are so rich. And how can we have a same conclusion that can be applied to those different regions? So what do you think about this? So for example, traditional financial inclusion probably is more important in Southeast Asia. I'm not sure whether you have the result on that. So how do you think the policy implications can be applied across those different regions? So what do your results say about the differences across those different regions?
Okay, yes, you're right. It's sure that when we do this study, we were thinking first about African countries, because as you saw with the statistics, when you look at the different indicators related to financial inclusion, you can see that when it's about traditional financial inclusion, Africa is lagging behind. So our first idea was to work on African countries, but there were no many data as I presented the source of data. We were limited by the availability of the data. Now it's true that yes, there are some different. The most striking difference comes from Africa, but you also have some regions like, let me remember, region like South Asia and Middle East and North Africa, which seems to present also low level of financial inclusion index. As for the index we have calculated. And I think that for those regions, our policy recommendation could also be applied, because you have some of the features that I observed in Africa that can also be seen in South Asia and Middle East and Northern Africa. For example, for South Asia, if I come back, are you able to see the screen with the with the histogram.
Mm-hmm.
Do you see it?
Yeah. Yeah.
Yes. So when you look at it, for example, when you look at South Asia and Middle East and North Africa, you can see that for the digital inclusion index, you can see that the level is low, and especially for penetration and access. So again, if you look at, let me see. No. Digital and financial inclusion. Yes, if you look at the level of digital financial inclusion and traditional financial inclusion, you can see that they are showing low level of those two index, and I think that the policy recommendation can be applied to these region too, because as I said, digital payments play an important role, and everywhere in the world, I mean, the young population is attracted by everything that is related to new technologies, and I think that it can also play a role as we advise it for Africa.
Mm.
So this is what I can see.
I see. Okay. So let me, before I give the floor to my colleagues, I already saw a hand. Okay. Let me invite. I think it's Yusuf. Hi, Yusuf. Hi. So you can.
Yes, thank you very much, Jamie, for giving me the floor to speak. And I Sandrine, I just have to apologize first because I wasn't present during most of your presentation. I almost came to the end. Then what I will ask probably doesn't make any sense at all. But I mean, basically my point is really on the target population, right? Because when we are talking about wage payment, I guess we are talking about formal wages. But most of the time, these populations, I would guess they are already included somehow, because most of those formal workers who receive wages usually have banking account, have account somewhere, to receive the wages. Then what is too much of a point, basically, if we want to address really financial inclusion, actually, right? Or unless, as I said, but I wasn't here for most of your presentation. Maybe you already make this point. Maybe I'm completely on the side. Yeah, sorry for that. Yeah.
Okay. Yes,
Thank you. Sandrine, do you want to respond? Yeah.
Yes. Thank you, Issa, for your question. It's very interesting. And yes, you're right. It's true that formal wage, wage is received in a formal context, and when it's given in this formal context, it means that this wage will be received by included person, but I think that I don't know how to work, how I can answer, but I think that when you consider informality, there is two types of informality. The first type is, of course, there are some enterprises who are totally informal in the sense that they are not related to the fiscal administration, okay? So they are not registered. But you have those type of enterprises who are registered, but where for which part of their activity won't be registered. So I think that if the regulation foster the payment of wage through digital means, it will also improve the inclusion of those persons who get a salary. And I want also to make the parallelism between what happened in Europe. In Europe, in the past, some wages were not received through an account, but it's after there was the legislation which fostered this, which set it as something that has to be compulsory. These lead to a greater bancarization and also a deeper financial inclusion. So I think that with digital finance, we can imagine that this can also happen. Yes. So this is how I can answer this question.
I do see Joseph's point. So basically, think about the African countries. How many people can be paid digitally? And you are talking about maybe a relatively small proportion. So there are something that we have not really considered in terms of. But I see you focused on digital payment. So my next question, and while we are waiting for colleagues to have more questions, so I'm thinking about your data actually. So you constructed those indicators. I do not know what kind of indicator, what kind of measure or scale they are. I imagine they are so that actually leads to the question about the methods that you are taking. So why did you use this logistic? And in your robustness test, you used a kind of probit. So why is that?
I think that the literature, this is what is usually done when you want to check for the robustness of the logit. You can use the probit to see whether or not there is a consistency between the two results.
Yeah, so but why probit? Your data is not a binary. Your indicators, I do not know whether they are continuous or in terms of the measurement, or they are categorical. But I do not see
the indicator evolves between 0 and 1, so they can be 0.1, 0.2. They are just bounded. And I think that when you have the dependent variable that is bounded, you can use a probit model as well.
Oh, okay. I do not know that. So I was wondering why you use those particularly those two. You used those two methods. Yeah. So you did mention that you treated for the endogeneity problem. Yeah, but I'm not aware that you can use a probit model if you have that type of data. If the data is 0, 1, 0, 3, 0, 4, why can't I treat them as a ratio data? So we normally need to scale the data anyway, scale the variables anyway. So I see a hand is Jeffrey's hand. Jeffrey, yeah, come in, please. Thank you.
Yeah, thank you. Thank you, Sandrine, for your presentation. I have two comments or suggestions, if I can put it that way. And then I think the first one has just been touched on by Professor Bo, because I wanted to say that your data and your methodology, because in a way, the data is actually ratios, is because ratios are between 0 and 1. So if you have 0.1 and 0.2. Those are ratios, so not really binary. That's the first one. I think Professor Bo has said enough there. My second point is regarding.
Excuse me. I think that this is what I have said. I said that the financial inclusion index, it's an index, okay? So when it is calculated, it's evolved between 0 and 1. So when it is bounded, if you use traditional least square regression, the result will be biased, okay? So the literature suggests that to use the logit model. Now, if you look at literature, I mean, even in the paper quote by Professor Hongbo, when she was introducing me, which has been published in Journal of Comparative Economics, we do both. We do a logit and a probit model. So I think it's something that is done when you want to make an alternative method to see whether or not your results are consistent.
Okay. Let me just add my second point quickly, which is regarding your data. I understand that you have 3 years, and which the first round 2014, 2017, and 2021 for the World Bank survey data. So I was wondering whether you've considered extending this data, because I remember I've read few papers on banking regulations where they have used the World Bank survey data. What they have managed to do in those papers, and they argue that the data published in 2014, for example, in your case, that data was not collected in 2014. So that data was collected the previous 3 years. So they have argued, and I think the paper was published in the Journal of Finance, Banking and Finance. They argue that they cover the previous 3 years to 2014, that the one in 2017 would cover the previous 3 years to 2017, and the one for 2021 will cover the previous 3 years to 2021. So in your case, you would have like 8 to 9 years data. So I don't know if you've considered something like that. That will extend your time.
No. The issue here is you are talking about taking into account digital financial inclusion, and you have to keep in mind that fintech is recent. And I mean, we look at the data, I mean, previous data before 2014, but I think that the years where we had enough data, availability of data as for digital financial inclusion was 2014, 2017, 2021. And we were limited in these aspects because we are we take to encompass in the calculation of financial inclusion, the digital financial inclusion, okay? And this is one of the things that we mentioned at the beginning of the paper. I mean, I mentioned it in the introduction because of the recent quick evolution of fintech. When you talk about financial inclusion, you have to consider digital financial inclusion because there is a lot of evolution that has been made with fintech, which has changed the profile or the evolution of financial inclusion. And because we wanted to encompass in our index the digital aspect of financial inclusion, we were limited in the data. So the data we takes into account digital financial inclusion begins with 2014. So we have 2014, 2017, and 2021. This is the first thing we made before making our analysis. It was checking for the data, analyze the data, make some descriptive statistics, and you can trust us. We made a lot of work on descriptive statistics. We make a lot of work on preliminary statistical analysis.
Okay, I understand. But the point these guys made is that, for example, the data they used is on banking regulations, which the first round was published in 2013, 2016, and 2019. So they said that they've checked the World Bank survey system, that the one that was published in 2013 was collected the previous 3 years. So they've managed to argue their case that, okay, that data will represent the previous 3 years, same for the 2016. I can look for the paper if I can find it, I'll send it to you. Otherwise, your argument you just presented work for you. Thank you so much.
Thank you.
Yeah.
Okay, thanks, Jeffrey, and thanks, Sandrine. If I can add another thing that I'm thinking, Sandrine, when we say financial inclusion, we are thinking about the financial system of this country. So your data is on the country level, of course. First of all, I do not see that many variables that are control variables, I mean, that are related to the financial system or either the banking or stock market things of this country. So I do not see that. But I'm thinking, if we say financial inclusion, I'm really thinking about the financial system of this country. And I understand that this is probably what you meant by traditional financial inclusion. And I have a little bit of problem with your treatment of this digital financial inclusion, with digital wage payment, and then the impact on digital financial inclusion. To be honest, if I think about African countries, yes, everybody has a mobile. Even the farmers, they have access to their mobile phones, and they may use their mobile phones to get a small amount of loans. So yes, it is a kind of access. But do you say in those African countries, although they have a lot of a higher digital access, or maybe the usage, but do you say that they have a higher level of financial inclusion?
A higher level of financial inclusion when we consider digital financial inclusion? I
mean, in general. So yes, if African countries probably it has a higher indicator in terms of using digital something, but can you conclude that the level of financial inclusion is higher there? So because their traditional financial, let's say the financial sector or the financial system is very much lagged behind. So, for example, people do not have a bank account, but they have the mobile phone. But do you say if they use a lot of mobile phone, do you say that their financial inclusion is higher? I'm struggling in understanding. If I say financial inclusion, I would mean the financial sector development, or I would mean maybe what you mentioned, the traditional. So I saw some papers that they check the digital things and the impact of digital access on proper financial inclusion. But in your case, you pick the wage payment, the digital wage payment, and then you are arguing that the wage payment can increase financial inclusion, even though they have nothing to do with the financial sector development.
Yes.
Do you see? I mean, I'm thinking about that. If I'm thinking about financial inclusion, I'm thinking about the development.
Let me answer you. Here, if you can see the screen, you have the calculation of the digital and traditional financial inclusion. And you can see that there are different, whether you consider the different regions and also the year, okay? And you can see that, for example, let's leave apart Sub-Saharan Africa. Let's consider South Asia. You can see that you have financial inclusion, traditional financial inclusion, and digital financial inclusion. So for 2014, for example, you have digital financial inclusion for South Asia, which is 0.11, and traditional financial inclusion, which is 0.18, something like 0.18 or 0.2. So with the index we have, we calculate both kind of financial inclusion, the traditional and the digital financial inclusion. So this is one thing to keep in mind. So this means that when we do that, we consider how digital financial services help in building financial inclusion. So this is one thing. The second thing is you have to keep in mind that when I introduced the paper, I said that for all those others who have worked on financial inclusion, they pinpoint the importance of including those who are excluded from traditional banking system, okay? So this is why the statistics we have are statistics that come from survey, and they are not available every year because they are made through survey, and they are made through survey to grasp those people who are traditional excluded from the bank or the formal or the usual financial institution. So this means that with those statistics, the real issue is to grasp this idea, to grasp all policies that will help in increasing and improving financial inclusion, in the sense that those policies will help to touch those people who are not who have not an account in a traditional bank or so on. So you have to keep this in mind. And also, the second thing that I would like to say is the fact that, yes, we can think about digital financial inclusion, digital payment. But the thing is that if you consider digital payments, these digital payments can lead some people to use other digital means of payment, and even to use some traditional means of payment or traditional financial services and traditional financial products. So this is what I think, because if you receive a digital wage, and you are able with this digital way to make to pay bills using digital means of payment, you can see that it allows you to be financially included, in the sense that you have access to some financial products, you have access to some financial services. So I think that the thing to keep in mind here with those data, with those particular data, because those are data that are collected with this idea of grasping financial inclusion in the sense that in developing countries, you have part of the population that are not captured, but statistics that are in banks, in traditional banks. So this is why I think the World Bank, the IMF, draw this survey in order to have those statistics. So I think it's important to make the nuance here, okay? And I'm pretty sure that the results I have here, they can find some explanation, because if someone is able to have a digital wage, because he has this digital wage, he has a mobile phone, he can make some digital payments, he can even be fostered to go to traditional means of payment, or to use traditional financial services or traditional financial products. So this is what I think. And again, the second question, the first question, that's the second question you asked. The first question you asked about the control variable. The control variable you find here are the control variables that are usually found in the literature related to financial inclusion, okay? And again, if you, in relation with what I have said, we think about financial inclusion here with those data, we think about financial inclusion as a concept which is directed toward population that are excluded from traditional financial services, okay, traditional financial institutions. So when we think about this, we have in mind those three aspects of financial inclusion that are access, penetration, usage. This is why in the control variable, you have the literacy rate, because it's related to penetration, to access. You have the level of development, the FDI, and so on. So they are usual variables that are generally found in the literature related to financial inclusion.
Yeah, well, your answers are very powerful. So I would say, yeah, but my point is, so think about farmers who have access to mobile payments or maybe a little bit long, and they do the transaction and they pay each other. But if they go to a bank asking for a mortgage loan, it is not necessary that they can get the loan. So so that's my point. So so for me, if that is the case, then we should check the impact of either the traditional financial inclusion or digital financial inclusion on another thing. And that another thing may be the welfare, maybe, you know, something that, but but I see I see your argument as well. So let's see whether we have more questions on the floor. Colleagues, do you have any questions? Okay, so at least we actually did quite a lot. Sandra, thank you very much for your very detailed, careful presentation, and your answers are very powerful. So if there is no more question, I would like to conclude the session. Sandra, do you have anything to say? But from us, we thank you very much for your contribution.
Thank you for inviting me, and it was an interesting discussion. I will keep your question and also your remarks to see in which how I can improve the paper. Yes, so thank you very much.
Yeah, thank you very much, Sandra. And we'll talk, you know, about everything later when we have the chance. And thanks, colleagues, for your time. And so we will close this session. Hopefully, we can see you next week. Okay, bye-bye.
Thank you. Bye.
Bye.